Hello everyone, I hope you're doing well these days. As you know, the unseen circumstances, the unfortunate circumstances eventually led us to continue part of the semester with online sessions. So in this video I'm going to introduce and explain chapter 6 that has to do with merchandising inventories or activities. Merchandising activities. So far in the course, in the financial accounting course, we have been dealing with companies that provide services and not companies that provide merchandising activities. So when we are dealing with companies that provide services, so before we start, this is chapter 6, merchandising activities. So what I was saying is that when we are dealing with companies, a service company has an income statement that basically includes revenues and then deduct expenses to get your net income, right? Because in a service company there aren't any merchandise or inventory included. So we're talking about, when we say merchandising activities, we're talking about a company that purchases or manufactures some goods and sell them to customers or to retailers. It doesn't matter. So however, in a merchandising company, the income statement would look like revenues, or what we know as sales, minus the cost of the goods that were sold. Cost of goods sold that we know as COGS, C-O-G-S, right? This will get us the gross profit figure. Then we deduct other expenses, and these expenses are multiple, several ones, including depreciation expenses, utility expenses, salaries expenses, wages, taxes, interest, and so on. All of these expenses, when they are deducted from the gross profit, you will end up with net income or net profit. And just to remind you the difference between a gross and a net, I always remind me of the apple can example. So if an apple can, so this is the apple can, pineapple can, and it says net weight and gross weight. Usually the gross weight, for example, is 400 grams, and the net weight is always less at 250 grams. The difference between these two is the water that is in this pineapple can. So the 150 grams difference of water is similar to the expenses in this case. So after deducting expenses from gross profit, you will end up with net income. After deducting the weight of water from the gross weight, you will end up with the net weight. Okay, enough says on the difference between net and gross and the income statements among both. Now, the operating cycle of any merchandising company, and just out as an example of a merchandising company, Walmart is a merchandising company, Spinneys in Lebanon is a merchandising company. The operating cycle basically has 3 main parts, where we first purchase merchandise, and in this case we are adding to our beginning inventory. Then we sell, so sales, and here we are. After doing the sales, you need to compute your ending inventory. We'll go through this in details, don't worry about that. And finally, you need to collect receivables and pay payables, right? When you purchase, you will have an account payable associated with the value of the inventory you purchased. When you sell, you will have an account receivable associated with the revenue that you generated. So eventually, you'll collect the receivables from the customers that you sold to, and pay the payables that you owe the suppliers. Okay, now under this merchandising cycle or merchandising activities, we have two systems. So we have two systems of merchandising inventories. The first one is the perpetual, and the other one is the periodic. Now, nowadays, due to the technological advancement, almost none of the businesses, of big businesses, use the periodic. But you know, to appreciate the importance of the perpetual system, you need to understand the periodic system. So we always learn history in order to assess our current state and our future. So we are learning the periodic in order to appreciate the importance of the perpetual system. The perpetual does these three activities continuously, automatically, up to date. Every time you make any transaction, the system is automatically updated. The periodic is slower, it's slightly outdated, and I explain how these two systems differ from each other when it comes to these three activities: the purchase of merchandise, selling the merchandise, collecting receivables, and paying payables. So under the perpetual system, all transactions are up to date and continuously recorded. Okay, I'm talking recorded accounting wise. In the periodic system, we cannot keep track of cost of goods sold or goods available for sale throughout or within the period. So assuming that we close our cycle or accounting period every month, if the manager asks us within the period or within the month, at the 15th, for example, the manager asks for a figure of the cost of goods sold or the goods available for sale, we cannot automatically get this number from them. We need to go back to the warehouse and do a stock count, unlike the perpetual system where everything is continuously recorded and updated. So instead, this is done at the end of the period. So at the end of the period, you go to the warehouse and make a stock count, and you can determine your available balance, which is basically at the end of the period. It means that the next day it will be the beginning inventory for the following period, right? Okay, so these are the two merchandising systems that we'll be dealing with. Now, as for the rest, which are these three activities under perpetual and periodic, what I will do now is that I'll give an example and explain how these two systems behave under these three activities. Okay, so if you are using a perpetual system, how you purchase merchandise, how you sell, and how you collect receivables and pay payables. If you have a periodic system, how you do the same thing. Now, the example says, so example. On June 1, ABC Incorporation purchases 15 identical vehicles at the cost of $12,000 each. Okay, the sale was made on credit, which means that ABC company did not pay the supplier in cash. It was made on credit. The selling price of each vehicle is $15,000. Okay? The company had 5 vehicles in its beginning inventory. The company closes its accounts at the end of each month. Okay, so these 5 vehicles on May 31st, so the day before, this was the ending inventory. On the next day, June 1, given that the cycle is 1 month, this has become the beginning inventory. The company sold 16 vehicles during June. Okay, now the question says, record the journal entries for purchase of vehicles, sale of vehicles, collection of receivables. We always assume here that when we purchase we will pay later on, and when we sell we will collect later on. And this is what happens in the real life examples, especially between business to business operations, B2B. Collection of receivables and payment of payables. Also, the question asks, state the value or the balance of beginning inventory cost of goods sold and ending inventory. Okay. In part A, assume that ABC Incorporation uses the perpetual system. In part B, assume that ABC Incorporation uses the periodic system. Okay. So, part A, answer. I'll do them like this. Part A and part B. In part A, so actually I'll do one more thing, that I'll do this thing here, and then I'll do like this. So A is the perpetual, and this is the periodic. Okay. So the first economic activity was purchase of the vehicles. So purchase of inventory. Then they asked for sale of inventory. Then for collection of receivables. Collection of receivables. Then payment of payables. And finally computation. Actually, you know what? I'll do the computation, these three things, beginning inventory, cost of goods sold, and ending inventory. I'll do them on the next page. So the first thing is to purchase inventory, how you record this accounting wise, how you record sale of inventory, how you collect your receivables upon making the sale, and how you pay your payables which you owe the supplier, right? Purchase of inventory in the perpetual system, it's basically saying that you are adding to your existing inventory in the warehouse a new inventory. So inventory is an asset which increases by a debit transaction, and therefore inventory should be debited by how much? By 12,000 multiplied by 15, right? This is what we purchased. So 15 units multiplied by $12,000 for each, so $180,000. This is the inventory. As for the on the credit side, so you purchase this inventory and on credit, it means that you haven't paid yet, so it's a payable, it's a liability. So you will have a balance of accounts payable $180,000. As you know, I mentioned the currency sign once at the very beginning, and this is new to you. This is a U bar, which is an abbreviation for the word unit or units. So this is in the perpetual case. In the periodic case, so as you can see, I'm solving in parallel just to do the contrast so that it gets stuck in your mind better. So in the perpetual inventory accounts payable, in the periodic we don't have an inventory account. We have instead a purchases account, and we will see this later on, and we'll explain why it's the case. So $180,000 purchases and accounts payable, the same value, right? Okay. Sales of inventory, it's funny, I'm asking if it's right. Anyway, sales of inventory, when you make the sale in the perpetual system, given that it's a synchronized and automated system, you will have to do two things. The first thing is to release the inventory from the warehouse. So you are getting rid or from some vehicles or some units, or you are releasing some of your units from the warehouse, and at the same time you need to realize the revenue that you made, right? So when you sell an inventory, some inventories, the first transaction must be, so your inventories are going down, so to decrease your assets you will credit it, right? So inventory, the value of the inventories that were sold is 12,000, which is the cost, multiplied by 16, right? So this will be $12,000 multiplied by 16 units. So this is 180, add to it 12,000, so $192,000, right? This value is the value of the cost of the units that were sold, or the goods that were sold. This is what you paid to acquire these vehicles, and therefore this is the cost of the goods sold. When cost of goods sold increases, what happens to owner's equity? Owner's equity decreases. Why? Because retained earnings decreases. Why? Because net income decreases when cost of goods sold increases. And therefore, in order to know whether cost of goods sold increases by debit or credit, think about owner's equity. Owner's equity increases by credit. When cost of goods sold increases, this owner's equity is decreasing, and therefore it must be the opposite way, the opposite direction. So cost of goods sold increases by debit, which decreases owner's equity, and thus you will have cost of goods sold on the debit. You can memorize it, but it's better to understand it. 192,000. At the same time, we need to realize our revenue. You made this sale, as I said in this chapter, or any chapter that has to do with inventories. We assume always that, unless stated explicitly, that any purchase or sale is made on account or on credit. So in this case, you will have an account receivable because you didn't receive cash. An account receivable by how much? By 16 units multiplied by $15,000, which is the selling price. This is the selling price. So 16 multiplied by 15, 225 plus 15, 240. Just let me make sure. 240 exactly. So this is $240,000, and this is the receivable. On the other hand, on the credit side, you should have to realize the revenue, or the sales revenue. So sales revenue, or revenue, it's the same. Sales revenue is $240,000. Now, if you think about it, you have revenue of $240,000 and cost of goods sold of $192,000. So if you go back to the income statement, you will have a gross profit from this transaction, $48,000. Okay. Now, as for the periodic only realizes the revenue and doesn't have an effect on the cost of goods sold and inventory, because it doesn't even have an inventory account. These will be computed at the very end in one accounting record. Okay, and this is why it's an outdated or a slow system. So what happens here is that you will simply have account receivable and sales revenue. Okay, so we didn't release any inventory from the warehouse. Account receivables, the value of it is the same, 240 as the periodic, and the sales revenue, it's 240 as the periodic. Collection of receivables, so basically if you collect these 240, your cash will increase by 240,000, and you are not expecting any money from the customer that purchased from you anymore. The same takes place in the periodic. This is common between them. So 240, 240. The payment of payables also, it's the same. You are paying cash, so your cash will decrease in credit, and your liability also decrease. Liability, this is an account payable, decreases by credit. The liability was 180,000. Now you are getting rid of it, so 180,000 paid in cash, and this is the same for the, oh my god, this is AP, accounts payable, okay, accounts payable. So 180 AP. Okay, so as you can see, the collection of receivable and payment of payables are identical between both approaches. However, the purchase of inventory and sales of inventory are different between perpetual and periodic. Now, the last item in the question was to state the balance of beginning inventory, cost of goods sold, and ending inventory. So we are talking about state. I'm just making sure that you can continue with me on this slide or paper. State the value of beginning inventory, cost of goods sold, and ending inventory. What you need to know when calculating these three, that in part A, the periodic, beginning inventory, cost of goods sold, and ending inventory can be computed and traced, and updated. Actually, not can be, they are, it's a fact, are computed and updated regularly or on spot, and there is no need to initiate a compute or initiate a computation. Okay, so we already know that the beginning inventory in this case is equal to the value that was given in the question, and it's 5 vehicles multiplied by 12,000, which is the cost of each one. So 5 units multiplied by 12,000, and this is $60,000. The cost of goods sold is equal to, we can go back to the accounting records that we have, and you can find it right away, which is 192,000. So 192,000. If you look at the periodic entries, you don't even have a cost of goods sold figure, so you cannot determine it this way. There's another way that we will introduce in a minute. The ending inventory is basically, if you think about it, we had 5, we added to them 15, this is a 20, and we sold 16, so we are left with 4 at the end of the period, and therefore it's the ending inventory is 4 units multiplied by $12,000, which is $48,000. Okay, these are the values of the 3 accounts. Okay, I made a mistake here, and this is not periodic, this is perpetual. Sorry about that. This is the perpetual system. Okay, now as for the periodic, in order to compute the cost of goods sold in the periodic, given that the beginning inventory, it's given, right? Beginning inventory is given at 5 units multiplied by $12,000, and this is a 60,000. As for the cost of goods sold, you need to compute it. And if you think about it, if this is a timeline, this is June 1, this is June 30. Okay? On June 1, you had 5 units. During June, the purchases were equal to 15 units, and the given told you that you sold 16 units, right? So the cost of goods sold is equal to 16 units multiplied by $12,000, which is equal to 192,000, right? What about the ending inventory? The ending inventory is equal to the beginning, what you had initially, plus any additions, minus what you sold, right? In other words, cost of goods sold is equal to beginning, what you had, plus what you added, purchases, minus what you are left with at the end, ending inventory. Okay, so you will either have cost of goods sold and you will be asked to compute ending inventory, so you will use this or simply rearrange it, or you will have ending inventory and you will be asked to compute cost of goods sold, depending on the question. Okay, so this is all I wanted to tell you about from this question, to state the beginning inventory, cost of goods sold, and ending inventory. Now, what I want to highlight in this example under the periodic, that your accounting transactions, so the accounting transactions or entries needed to record cost of goods sold and ending inventory under a periodic system are the following. At the beginning, you sell all the inventory that you have. Everything that you have comprises the beginning inventory and your purchases. This is everything that we had before selling anything, right? So the cost of goods sold now is equal to the beginning inventory is 5 units multiplied by 12,000, and the purchases were 15 units multiplied by 12,000. So basically the sum of these two is $240,000, which is 20 multiplied by 12. So we know that this number is equal to $240,000. Is this the cost of goods sold? No, it's not. How can we adjust this? We adjust this by returning to the warehouse what was left, which is the ending inventory. So debit ending inventory. So now we are increasing our assets. We are adding back to our ending inventory. The value is 4 units multiplied by $12,000, and deduct this from the cost of goods sold. So decreased cost of goods sold by 4 by 12 is $48,000. So if now we compute that you have a debit $240,000 in cost of goods sold and a credit of $48,000 in cost of goods sold, so now you have a balance. If you open a T account for cost of goods sold, you have a $240 on the debit and $48 on the credit. You will be left with $192 as a debit balance, which is identical to this number, a debit of $192,000. Okay, so the periodic thing is more slow, it's manual, it needs an understanding of how inventory works, the flow of inventory, but all you need to know is that the last accounting transaction or entry you need to make in order to compute cost of goods sold and ending inventory in terms of accounting is to sell everything that you had. So release it from the inventory, you are decreasing your assets here, and then get back what you were left with, which is the ending inventory. In this case, the cost of goods sold will have the correct number, just like the perpetual. Okay, so this is basically the first part of the chapter, and the bigger part. It's not the more important; it's the bigger part. Now, the other part has to do with making a sale. So for example, you can make a sale and offer the customer, like if they pay within a specific period of time, they will get a discount. So we call them credit terms. So assume that you as a supplier make a sale on credit, so the guy didn't pay, and you offer the customer the following credit terms. When we say credit terms, we mean that you will get a 2% discount if you pay within 10 days. Otherwise, the full amount that you owe the supplier is due within 30 days. So to get this in the compact form, it's 210, and 30. So you will get a discount of 2% if you pay within 10 days. Otherwise, the full amount is due within 30 days. Okay, this is identical to this one. So this is called the credit terms. 2% of discount, so discount percentage. This is the grace period, let me call it. This is the full amount, and due date. So you cannot postpone paying beyond 30 days, otherwise something else occurs, just like the account receivable will become a not receivable, so you'll have to pay interest and so on. So this is what happens in this case. Now, let me give you a numerical example. The supplier, actually let me say the customer. The customer, or you know what? Let me use names. Example: ABC Incorporation, which is the supplier, okay, sells 10 laptops to XYZ Incorporation, which is the customer, at $1,000 each, with credit terms to 10 and 30. The cost of the 10 laptops for ABC Incorporation is $600 each. Okay, so now we have a company, ABC, that sold 10 laptops to XYZ, the customer, at $1,000 each. Credit terms are given. The cost of 10 laptops for ABC is $600 each. So 6,000, and the selling price is 10,000. Now, from the perspective of the customer, and then from the perspective of the supplier. Okay? Now we need to focus on one thing and keep in mind one thing, that the customer has the option to record these 10 laptops at two costs, one with a discount and another one without a discount. So the cost that has a discount is the net cost. Keep in mind this name. the cost that doesn't have a discount is the gross cost. So these two terms, net and gross, remind us of the difference between net weight and gross weight in the pineapple can, right? The difference between these two, in the pineapple can it was water, and in this example it's the discount. So the difference between the net cost and the gross cost is the 2% discount on the value of 1,000 multiplied by 10. So these 2% are less for the net, right? So the net is always less than the gross. It's always the case. Net is the lower, or the smaller number, or the lower value. So what happens here is that assume that the customer recorded the inventory at gross, so at the regular value, or the face value, or principal value. So this, the accounting entry would simply be inventory 10 multiplied by 10,000, 10 units here, $10,000. Inventory and accounts payable, $10,000. Okay, now if the customer pays the supplier after 1 week, which means that the customer paid the supplier within the grace period. After 1 week means at 7 days, which is less than 10. So this customer is eligible for the what? For the discount rate. So now the cash that will be paid is how much? Is the $10,000, which is the account payable, multiplied by 0.98. This 0.98 is what? Is the 100% minus the 2% discount, which is stated in the credit terms. So I will pay them, the customer will pay the supplier $9,800 instead of $10,000. On the debit side, you will get rid of the liability. So accounts payable is now gone by $10,000. Of course, we know in accounting by now, after all, that the debit must be equal to the credit. So the difference between the $10,000 and the $9,800 should be on the credit side for the equality to hold, and this difference is called discount taken. Discount taken. Okay, the value is how much? It's 2% or $200. Okay, now assume the opposite happened. Assume that, let me change this thing here. This is no more a supplier, it's also customer, but this is part 2. Okay, or simply continued, never mind. Now assume that the customer recorded the inventory at net. So you will have an inventory that has, so here the customer assumed that they will be able to pay their dues within the grace period, within the 10 days. So the inventory value will be $9,800. You know, the 10,000 minus the 2%, and at the same time you are liable by the same value. Okay. Now, also assume that the customer couldn't pay within the grace period, or discount period. I'm using the grace period, although it's called the discount period. So the accounting record would be that the cash that is paid, we know that it's $10,000 for sure. Always start with cash. It's the easiest approach. Always start with cash. Cash is $10,000, which is the principal value. 10,000 multiplied by 10 laptops multiplied by $1,000 per each. So this is the cash that the customer paid. On the debit side, you will get rid of the liability accounts payable, $9,800. The difference of $200 is discount not taken. It's discount lost this time. It will be on the debit. Discount lost, 200. A small note on discount taken and discount lost. You can simply know where to put it, to place it on the debit or the credit simply by equating both sides, or in a more technical analysis, if you lose your discount, it means that your owner's equity eventually will decline because your retained earnings will decline since net income declined, and therefore if owner's equity increases by credit, this entry which decreases owner's equity should be recorded or increased by debit. On the other hand, discount taken is something favorable for owner's equity, and therefore it increases by the same entry, by credit. Okay, this is everything that has to do with customers. Now, from the perspective of the supplier, the same example from the perspective of the supplier. Okay. I think that's fine. Yes, it is. As for the supplier, when they make the sale, they will simply have two entries that we know. The cost of goods sold, inventory, and these values are $600 multiplied by 10, so 6,000, and inventory 6,000. This is the release of inventory. The other concurrent entry or accounting entry should be account receivable and sales. The value here is 10,000 and the value here is 10,000. Okay, so as from the supplier's perspective, we always record these at gross. Okay, I'm just trying to follow up with the slides to stay on these, to be on the same page. Yes, exactly. Now, this is when the supplier made the sale. Assume that the customer pays the supplier within the discount period. Okay, so if the guy, just give me 1 second. Okay, yeah, we're almost approaching 1 hour. The discount. So if the assume that the customer pays the supplier within the discount period, the accounting records of the supplier should show the following. The cash received is 9,800. Why? Because the customer pays the supplier within the discount period or the grace period. So the customer will pay 9,800 to the supplier. This is the cash received by the what? By whom? By the supplier. This is why it's a debit. We are on the records of the supplier now, okay? Keep this in mind. So cash went up by 9,800. my receivables as a supplier should go down by 10,000 because I recorded it as 10,000 initially. And this is always the case. As a supplier, we always record the receivables at gross. We assume that the customer will not pay within the grace period. And this is the norm. The discount is the exception, and the norm is the principal value or the full value or the gross cost. The difference between these two is called sales discount. As simple as that. Sales discount is $200. Okay? Now, another assumption or example. Assume that the customer returned to the supplier 2 laptops from out of the 10 purchased laptops. So the supplier's records should show that our inventory increased by 2 laptops, or the value of 2 laptops, which is $600 per 1 laptop multiplied by 2 units, the sum of $1,200. This kind of transactions is the total opposite of a sale transaction. So inventory goes up and not down, and cost of goods sold goes down and not up. So what happens in this case, when you get back your inventory, your cost of goods sold should decline because you didn't do this sale anymore, and the income statement should not show this value of cost of goods sold, right? So cost of goods sold decreases by the same amount. Also, we need to flip this transaction. So account receivables should decline by $2,000, which is the selling price of the 2 laptops. And as I told you at the beginning of the semester, revenues or sales revenues cannot be debited unless we are closing our cycle, and therefore instead of debiting sales, which means that our sales declined, we debit sales returns and allowances, or simply sales returns. $2,000. So doing this, we simply said that we are not expecting these 2,000 from the customer anymore, because this customer returned some of the goods that they purchased, so our sales returns increased, which means that our sales decreased. At the same time, our inventory increased by 2 units. The value of them is $1,200, and the cost of goods sold declined by $12,000 as well. So now in the income statement, sales goes down by 2,000 and cost of goods sold goes down by 1,200. So as if in total we sold 8 laptops instead of 10. I need you to keep in mind that this account and this account, when they increase, both of them, sales discount or sales returns and allowances, when they increase, they cause a decline in sales revenue, and therefore we call them a contra revenue account. Just like accumulated depreciation is a contra asset account, this is a contra revenue account, because when they increase, they cause a decline in sales revenue. Okay, now if you go to the income statement, your income statement must show net sales minus cost of goods sold, gross profit, and you know the rest. Now this net sales here, this figure, is equal to sales minus any sales discount minus sales discounts and sales returns and allowances. So our sales eventually that should appear in the income statement as net sales are the sales that we made in principle minus those discounts and those that were returned. Okay, so net sales is sales minus the sum of sales discounts and sales returns and allowances. One last thing that I need to draw your attention at is when we have taxes. So now assume that, again, I'll remind you that these three examples are independent, okay, different assumptions. Assume that the government charges the supplier 10% of its selling price as a tax or as taxes. Okay, so suppose that the customer paid $1,000 to buy a laptop. So the transaction so the accounting records of the supplier must show an increase in account receivables or cash. It doesn't matter whether, depending on whether the customer paid on spot or will pay later on. So this is $1,000, and I know that there is a sales revenue associated with this receivable, and at the same time in this specific example I have a tax. So this is a tax payable, which is a liability. It's worth 10% of the selling price, so $100 for taxes and $900 for sales revenue. Okay, this will be given either as a percentage or as a numerical value. It doesn't matter that much. I think this is everything I wanted to tell you about in this chapter. Please don't hesitate to email me. Just make sure that, in case you have any question, just make sure that you study the slides and my notes. Not either of them. Please do study both of them. This is essential to get a full grade on your